Welcome to SIRA MCQ YouTube channel. Today we discuss advanced level A-level accounting paper 2025 question number 30. Look here, question number 30 related to long-term investment. This is theory part. Look here, what is the requirement? They request requirement. Look here, which of the following statements are? There are 4 statements there. Which of the following statements are correct? We find the correct statements. As to the evaluation. Evaluation means we measure, evaluate, good or bad. Okay. Evaluation of long-term investment project. Long-term investment project. Look here, first one. Value of the initial investment. You know there is an initial investment. You prepared the estimated cash inflow and outflow sheet. At that point, the 0 year, what is that value of the initial investment of a project equal to its present value? Look here, I prepare the cash inflow and outflow statement. Look here, this is the years. This is the years now. 5, this is the 0. This is the year 0, first, second, third, fourth. This is the years. You know what is the statement? Estimated cash inflow and outflow statement. Outflow statement. Okay, there is a top of this cash inflows. We minus, we deduct cash outflows. You know, initial investment is what is that? The final result of the this statement. This is the 0 year investment. Look here, I estimated 3,000 and 500,000. This is the initial investment. We write that total, the net estimated net cash flow. Estimated net cash flow. At that point, there are so many inflows there. I write 1,000. This is the inflows of other years. This initial investment is this one. Okay, you know what is their statement. Look here, value of the initial investment, you know, 0 year final result 3,500 of a project is equal to present value. Look here, you know, after the preparing this statement, you multiplied this one in discount factors. Why? To find net present value. Okay, at that point, you know what is the discount factors. 0 year 1, 0.9, 0.8, 0.7, 0.6, 0.5. After the multiplying this amount in 1, we can find the present value of these values. At that point, I find present values. 3,500 is initial investment. I multiplied in 1 discount factor. Answer is 3,500. Look here, present value of initial investment is equal to that point. In that point, present value is 3,500, initial investment is 3,500. You know, this is the equal result generated. present value of this initial investment is 3,500. Therefore, we can agree with this statement. Present value of the initial investment equal to this value of the initial investment. Therefore, this is the correct statement. Okay, look here the second one. When the net present value NPV, okay, NPV of a project is 0, NPV is 0, okay, it generates a return equal to its expected rate of return. Look here, what is the meaning of when the net present value of the project is 0? Look here, you know how can we find the net present value? After the multiplied discount factors, we find the present values, no? These are present values. We find the present values. 900,000 multiplied by 0.9, okay? 800, 700, 600, 500. All 1000 rupees multiplied by this discount factors. After that, we can find if there are inflow present values. 3,500 inflow. This is the 3,500 outflow. What is the net present value? Net present value is 0. Why? Initial investment equal to inflows present values. Therefore, the net present value NPV is 0. Net present value is 0. This is your situation, the current situation. They said that when the net present value of the project is 0, it generates a return. There's a return. Return means cash inflow. Return means cash inflow equal to its expected rate of return. Look here, what is the expected rate of return? Expected rate of return. Expected, you know 10%, no? 10% expected rate of return, 10%. What is the meaning of the expected rate of return? Expected rate of return. Expected rate of return equal to the top of that there is a return. Return means cash inflow. Okay, return is cash inflow. The expected rate of return for what? Initial investment. There is some initial investment, there is a cost we incurred to project. After that, we return cash inflows. This is the initial investment. At that point, I said you what is the meaning of the expected rate of return. At that point, 10% means this is the meaning of that. This is the meaning. Look here. This is the explanation. 100, 10. 10 is a cash inflow. Cash inflow, the expected. Cash inflow, return. Cash inflow and return. This is the 100 is initial investment. They invest 100 rupees. After that, they expect 100 rupees as a cash inflow, the return. Why? They expect 10% as a return of expected rate of return. Look here, this is the producer. Think about the producer. Producer get the initial investment is 100. This 100 is contribute from a bank loan. This is the producer. This is the producer. Project maker. Okay, they get 100 rupee on bank loan. You know, there's a bank loan, they charge interest. After that, after 1 year, there is a 10%. 10% means 100 to 10 interest paid to bank. Interest expense. You are the producer. Think about the 100. After 1 year, you produce a 100 biscuit, 100 value biscuit. You mark this selling price as 100 or no? You must mark a selling price as 110. Why? You must pay interest expense, and this is the loan portion, both of this. Therefore, you add this amount to project biscuit value. Therefore, you expect from return, expect from biscuit minimum 10%. Why? You must pay bank loan interest. Therefore, there is interest meaning of the 10%. Therefore, there are so many discount factors there. Look here. What are the meaning of the discount factors? Look here. The discount factors meaning, I said you, discount factors, look here, this is the years, 0, 2, 3, 4, 5, this is the years. What are the discount factors? Discount factors 1, 0.9, 0.8, 0.7, 0.6, 0.5. What are the meaning of that? You know, this is the meaning. There is 100 rupee cash amount is 1 rupee. 1 rupee cash coin is there. Under this, all of this. Look here, what's the meaning? In current year means 0 year. Current year, you go to the shop, give to seller 1 rupee coin, and you get this is the 1 rupee coin. This is the 1 toffee. 1 toffee. Okay, the toffee mean at the present time you coin a 1 rupee coin to seller, and you can buy 1 toffee and the full of toffee. This is the full of toffee. Okay, after 1 year you again go to the shop, give a 1 coin. 1 coin means 1 rupee coin. After that, the seller give you the part of the toffee. Why? This is this is toffee. This is a part of the toffee. 0.9, not a total. Total is 1 toffee, but he give you the 0.9 toffee of total. After second year, you give him a 1 rupee. Please seller, give me a toffee. At that point, the toffee portion is again deducting. There is a small portion, 0.8 toffee give you him. Why this is the toffee is decreasing year by year? Why? Toffee price is increasing. Why? Look here, how can we calculate? Look here, this 0.9, how can we calculate? You know, you want 1 toffee. Okay, in first year you know 1 rupee. Okay, 1 toffee, you say 1 toffee. It's a toffee is top of that toffee. You give him a 1 rupee. Okay, 1 rupee. After that, year is after, you want a 1 toffee. This is the toffee. 1 toffee. Here you know there is a 1 coin you give to the seller and you get 1 toffee. After that, within 1 year, you go within to get 1 toffee. Okay, you after 1 year, you go, this is the year 1, this is the year 0. Year 1, after 1 year, you go to purchase 1 toffee. At that time, what is the actual situation? Look here, I erase this one. After 1 year, you want to buy 1 toffee. This is the toffee. You know, this is the toffee. Toffee is there. Look here. This is toffee is there. Okay. Toffee is there. This is 1 toffee to purchase. You want to purchase. At that point, after 1 year, what is the toffee price? The seller said that the 1 toffee price is increased by 10%. Why? You know, the 1 rupee, the seller, the producer invested 1 rupee to create a toffee from a bank loan. He get a 1 rupee bank loan and create a toffee. Okay, at that point, there is some 1 year was passed. In that point, there is after 1 year, you know, bank will charge from producer 10% interest. Therefore, the seller add some interest. This is the 1 rupee coin. He add 10% for 1 rupee. 10% for 1 rupee means 10 cents. Therefore, 1 rupee, he add 10 cents. At that point, 1.1 is the new toffee price after 1 year. Why? He expect from toffee after 1 year interest. Interest is 10 cents. Therefore, he add to this toffee. After that, we can find the selling price of toffee after 1 year, 1.1. Therefore, to get 1 toffee, this is the toffee. To get 1 toffee, you give to seller how many rupees? 1 rupee and 10 cents. Therefore, we can find the simplified answer dividing this. Look here, 1 toffee dividing 1.1. Okay, we find the actual situation of that. Use the calculator. Look here, to get 1 toffee, you pay 1.1 in 1 year. After 1 year, 1, look here, 1 dividing 1.1, what is the answer? Look here, 0.9. This is the answer. I create 0.9. This is the 1 rupee. This is the 1.1 rupee used to get 1 toffee. But at the simplified meaning is you give to the seller 1 rupee, you can buy 0.9 toffee. Okay, the toffee partition is decreasing. Why? The toffee price is increasing. Therefore, we can simplify this 0.9. Look here, this is the 0.9 toffee. This is the simplified of this meaning. Okay, you want to 1 toffee, but you give the seller 1.1 interest rate. Okay, required actual rate of return. Okay, expected rate of return. Therefore, what is the meaning of this one? Therefore, look here, 0.9 meaning is this one. 0.9 meaning is from 1. Look here, there is a 1 rupee. After that, you get 0.9 but look here, this one, look here, 1 rupee you can get only 0.9 toffee. 9 toffee. This toffee meaning is present value. You give the seller 1 rupee, after that you get only 0.9 toffee. What is the remaining balance is 0.1. What is the 0.1? Interest. Okay, interest. This is the interest. Interest meaning the seller, you give him to 1 rupee, you give him 1 rupee to seller producer, but he give you the 0.9 toffee. Partition. Why? 0.1 is expected return, therefore he hide it. Interest is expected return. The expected rate of return, expected rate was hiding from these discount factors, therefore this is included 0.2 to complete 1 rupee. This is include 0.3 interest, this is include 0.4 interest, this is include 0.5 interest. Okay, 0.5 interest. At that point, look here, the multiplication of this one. Look here, you give him the 1000 rupee, but the toffee is present values. Present value is 900. Why? There is a gap between 100. What is the gap? Interest. Look here, at that point, this is the gap is 100, no? This gap is, look here, 200 interest. This is 300 interest. 400 interest. 1000 and 600 gap. 400. This is 500 interest. At the net present calculation, the present value is inflows is 3500. At that point, the seller, the investor, already get, what is that? Expected rate of return is, he got it. Why? He display you the present value is toffee 3500. Why? Look here, there is a cash 1000, there is a 5000, there 5000 rupees inflows, but these are the deduction. 1500 was totally deduct. After that, present inflow was 3500. The display of the inflows is 3500. Why? Expected rate of return is already covered. He get easily, he hide using these discount factors. Expected rate means interest. Okay, interest was hidden using these discount factors. You know the next present value is 0, but he expectation is already done. He hide the interest, expected return. Therefore, look here, this statement is correct. Why? When the net present value of the project is 0, but you know he hide the interest expense, therefore it generates a return. Return is interest equal to this is expected rate of return. Yes, expected rate of return is interest 10%. He already covered this expected rate of return. Why? At the present value calculation, he already hiding interest expense. Why? Expected rate of return was hidden. After that, we must calculate the NPV. Therefore, NPV is 0, but expected rate of return already done. Okay, therefore we can agree with this statement. This is the major point. At the theory part, you cannot identify these explanation. Okay, look here. Next point we go. The second one is okay. Let's see. cash received at the present, cash received at present for the project is more valuable than same amount of cash received in future. Look here, cash received at present, the present time, cash received at present. Look here, cash received at present. Present means like here, this one is present. Look here, think about this one. Cash received in present is 1,000 and cash received at the present for a project, okay, project is more valuable. The present values, cash received at the present for the project, cash received in present more valuable than same amount of cash received in future. Why? Look here, use the discount factors, you know, again, you know, at the zero means present, you get 1,000 rupees. This is the value, the cash value, the zero, this is currently I multiplied in discount factor. Why? To find the, this is discount factor is 1, we multiplied, after the we can find the present value. Present value means toffees. At the present, you invest 100 rupee, you get 100 rupee, you can purchase 100 toffees. They are the present value. Present value means the actual internal value. Therefore, there is 1,000 rupee, and you can get 1,000 toffees. But after 1 year or 2 year, look here, there is a 2 year. There's a 2 year, you can get 1,000 rupee. There is a cash after 2 years. Use the discount factor is 8 multiplied by 1,000. The answer is 800. The present value means toffee. You can get 800 toffees. The same cash amount, but the presently you received 1,000 rupee of cash, you can get 1,000 rupee. The present value means toffees, okay, actual internal value. After 2 years, you get 1,000 cash note. After that, you go to the shop and get toffees. The present value is 800 toffees. Therefore, you can easily imagine that the present time is more valuable toffees. Why? The same amount received in after 2 years, there is no value. Value is decreasing. Why? Value is measured through the toffees. There's a toffee is decreasing. Therefore, the presently received cash 1,000 is more valuable than there is a after 2 years receiving cash amount. Therefore, we can agree with this statement. Look here. Cash received at present, the 1,000 at present received for the project more valuable. Valuable means toffee. Valuable than same amount cash received in future. The future receiving cash amount, the toffee value is 800. But the currently received 1,000, we can get 1,000 toffees. Therefore, the cash received the present for the project more valuable than same amount cash received in future. Future same values are decreased. Why? There is a toffees we cannot get more toffees using this same amount. Why? The goods and services prices is increasing. Therefore, the value, the internal value is good and service. Toffees are decreasing. Therefore, we can agree with this. this last one. When a project is evaluated based on the net present value, it considered only the net cash inflows received until its initial investment is covered. Look here, you know the payback period at that point when the project is evaluated based on the net present value calculation. It consider only net cash flows received until its initial investment is covered. No, at the, you know, this is the net present calculation. No, this is the net present calculation. At the net NPV calculation, we considered all years cash inflows. Look here, this is all years. There is a 5 years. They are all 5 years considered to net present calculate. Okay, this is the estimated cash inflow and outflow statement. You know, there is all years are agreed with the net present calculation. But this statement said that it considered only net cash flows received until the initial investment is recovered. The initial investment is recovered. Look here, initial investment is 3,000, no, 3,500. It covers in 3 years and some months. 1,000, 3,000 is covered. The 1,000 is the last one. 3 years and 3 months, so 6 months after that payback. Just look here, how can we calculate payback period? 3,500 covered these cash inflows. 1,000. There is a 3 years, 2, 3. The remaining balance is 500 dividing in 1,000. The next year balance multiplied by 12. This is the 6 months. The payback period is 3 years and 6 months. After 3 years and 6 months, this time is recovered. The initial investment is covered 1, 2, 3 and 6 months. Therefore, they said that until the initial investment was covered, cash inflows are considered to NPV. No, cash inflows of, look here, this cash inflow until to end of the project we must consider. They said that until to payback period. Okay, therefore this is incorrect one. We considered all years cash inflow. It considered only net cash flows received until initial investment covered. The initial investment covered 3 years and 3 months. Okay, after 6 months, 3 years and 6 months. You know, there's all 5 years considered to net present value calculation. Therefore, we cannot agree with this statement. Therefore, answer is ABC only. Answer is 3. 430. After that, there is easy questions. There are 31. In next video, we meet question number 31.